speaking of that, AI is driving a structural shift in the IT services industry, changing delivery models and how companies invest in technology. My colleague Neeraj Shah spoke with the Mphasis CEO, Nitin, Rakesh, about what this means for the industry. Listen in.
Nitin, what is then the moat for an industry, which is, let's say, the Indian IT service industry at large, or maybe not just India, but companies global as well, which had this IT service model, because the people knowledge, the engineering skills were the moat. Now, if the offering is built on top of a service or a LLM which is provided by somebody else, then almost anybody else could do that work as well, presumably. So is there a moat and therefore an ability to charge, or does that dissipate over time?
So, there are three things that you need to think about, right? Yes, end of the day, an LLM is also a tool.
Yes.
Right? There have been, for the last 50 years, we've seen new tools come up, right? Internet was a massive enabler. Digital tech, cloud, CI/CD pipelines have been around for the longest time. We've seen massive breakthroughs with machine learning. All of these are tools that are available. Because I'm using a tool doesn't dissipate my moat. My moat comes from understanding the client domain and the context. Our moat comes from the ability to actually make it real inside of the client context. And more importantly, if you accelerate on top of that with a set of platforms that we are actually investing in, because we are trying to codify a lot of the services that we used to do with people into a set of platforms that can be deployed for reusability, scalability, efficiency, and bringing together a secure framework to deploy a lot of these new tools that are coming about. So I think the moat will come from a combination of domain, context, and IP that you build. And the more, it is an ecosystem play. We have been, and we will continue to play with the hyperscalers, the LLM providers, just like we've demonstrated as an industry the ability to play with the large cloud providers. Remember, cloud was disruptive to data center businesses, right? But it led to a whole new wave of revenue that was created out of writing new software and making sure that the old software works in the cloud environments. I think this is a little bit bigger, this is a little bit faster, but contextually, we are not in a model where our moat will disappear because we are using third-party tools.
Got it. Nitin, can I make it slightly simple for my understanding and maybe the understanding of a few of the viewers? If
Sure.
An Mphasis, or forget you right now, but the industry-wide, if there was an offering of a bouquet of offerings, which could be, ERP, BPO, etc., a multitude of segments that were being offered by a typical IT service offering, maybe 5 years ago, 4 years ago, maybe 10 years ago, maybe 2 years ago. And now when you're going with a new offering, which is, agentic AI plus the understanding that an IT firm would have, is there a change in the billability from the client for that offering? Something that may come on top of it is separate, but is there a change in the billability or is there not?
So, Neeraj, the short answer is yes, there is, because what we deliver is changing, how we deliver it is changing, how we solution it is changing, what tools we deploy is, is definitely going to change. We can't fight that, we have to just embrace it. I'll give you two examples. If you think about production support, right, application maintenance, L0, L1, L2 help desk, all of these were, or still are, many cases, managed services, fixed price models, but the payment mechanism was per incident. That model is shifting very, very quickly to availability or a fixed fee, because we don't want to be in a model where we are letting an incident happen. We are going further left and shifting left and saying, let's go predict an incident. Let's use big data and machine learning to do predictive analytics. Then let's use LLMs to do preventive fixes, because we can train an AI agent to do the fix before it becomes an incident. In that case, you can't get paid for the incident, but you can either get paid a flat fee or you can get paid for what we call availability. So the billing model will change. The client may pay less, but a lot of that money is going to get redirected into writing new software, modernizing applications. And hence, again, we've talked about these concepts that you move the operating cost, the run cost into the change cost. So the run the business spend will go into the change the business spend, and effectively you're creating new TAM while the client spend may or may not even actually go up. So I think the ability to drive efficiency will mean that the billing model might change, and that's progress. We've seen that happen in the digital era, where 30 to 40% of application development used to be testing. It's probably less than 10% today, and that's the law of this business, right? You evolve, you adopt new tech, and you deliver things differently.
Okay. Think 2028, maybe 2029, or you might argue that Neeraj think 2027. But what are the capabilities that an IT service firm which doesn't own these LLMs, right, is building or has, which a client therefore, which a Palantir or an Anthropic cannot disintermediate from a company like Nitin?
So I think if you think about, and without necessarily getting into the business model of some of the other firms, but if you think about an enterprise environment, I think it's very important to understand the difference between greenfield and brownfield. A lot of the greenfield work looks very, very appealing because you can demonstrate capability in a greenfield environment. You can do a project in a lab and say, I can now do underwriting with 20%, 30% less people, or I can do claims processing where you can eliminate 70% of the staff. But when you start talking about brownfield, again, domain, context, and platforms really matter. And finally, taking accountability over just having tools is really the biggest difference for an enterprise. So we can't look at the world outside in and say these tools are great. They work, they may help maybe new companies, they may help the mid-market or the smaller companies because they never had the budgets. So they can now do more with less. But effectively, the ability to orchestrate that tech inside of an enterprise is the biggest moat. And the most complex engineering problems that were probably getting pushed aside, for example, legacy modernization, we've looked at it for years. It used to be complex, core systems transformation, ERP transformations, ERP migrations. We can now start attacking those problems because we have these powerful tools that actually take not just the cost and time out, but they take the risk out. So I think to me, the ability to open new markets that were too complex or too hairy for customers to undertake, new segments within the spend, will definitely be there. The one last thing I'll make is whenever there is a pivot, and we've seen this in the last 2 cycles with the internet and digital, I think it's a very risky strategy for investors to look at the whole sector, and it's hard not to. But you have to figure out which companies are making the right investments and which companies have the right ability to be on the winning side of this trade.
And therefore,
that's the thing that it's become. You started with the micro. This is where I would say micro matters the most.
Amazing. And my last question to you is to Nitin Rakesh, the CEO of Mphasis, but also somebody who's run an asset management firm and been in financial services. But just before that, Nitin, so what you're effectively telling me is that could it happen that a large firm which depended heavily on ERP in the past can still kind of adapt to this, or will it be difficult? Will an elephant be able to dance, or will it be actually advantage companies with a smaller legacy book? What do you think?
Yeah, I think size, in a way, is an impediment, but that doesn't mean that you can't dance if you're an elephant, right? We've seen, look at IBM. 100 years in, it's a company we all, I really admire. And I think what Arvind's done with IBM is amazing because he's pivoted the whole company to basically software and AI software, right? So, Elephants Can Dance was a book written by an ex-IBM CEO, right? So there's definitely something going on there. So I don't think it's out of the realm of possibility that, just because you're big, you won't be able to pivot, but you have to make the right investments. And I think this is the one message that I have, for our industry colleagues as well, that if we don't invest in the right set of capabilities and not just people, but IP assets, maybe buying some capability and competency, that I think will be needed for us as an industry to accelerate this pivot.
Got it. Nitin, one last question, because you've headed an AMC before as well. For IT service companies' valuations, right? The stability of the cash flow with the billable hours model was fabulous. It gave a higher multiple to these companies, right? All through. Now, some companies have changed, some companies haven't, some companies are changing. But if indeed the share of the ERP and the legacy work is very high, when in trying to pivot, that revenue model or that cash flow kind of comes off, does it hit valuations? Now, please don the hat of an AMC guy. It was many years ago, but I'm urging you to do that. Will it hurt the valuation multiples?
So, Neeraj, in the short run, because of the volatility, uncertainty, fear of the unknown, new, it's definitely going to put some pressure on investors' psyche. And whether we like it or not, investing is a psychological as well as a scientific process. I think it's up to us as an industry to give that predictability and repeatability of earnings, cash flow, and growth. I don't think at heart the model is going to move too far away from all the merits that we've seen. We are long dollar always because revenues are in dollars. There's a natural hedge. We have the ability to generate high free cash flows. We have the ability to invest. We effectively have very, very healthy balance sheets. None of that is changing in the short or medium term. I mean, forget long term. I don't think ERP is going away either. I don't think of any enterprise that will wake up tomorrow and say, I'm going to get rid of my SAP or Oracle, core platforms. So the only variable will be growth rates, and that will vary by company.
Nitin, I'm going to ask you, I know I'm making it a habit of asking you one last question, but it's just that we don't get to talk too much. And I know it's very late for you, but I'm going to ask you maybe one final question. Might be a difficult one for you to answer. So I'll agree, I'll understand if you don't want to. But do you reckon when you look industry-wide, I'm not asking you to put names here, but when you look industry-wide, that the IT service companies, by and large, India, globally, etc., are making this pivot fast enough to be as relevant as they are right now, 3 years, 4 years hence, or are there is the rate of change slow out there because it's very easy to like the billable hours cash flow?
Yeah, I think again, Neeraj, each company will have to find its own North Star strategic approach. In general, there will be some common elements, but it varies by your portfolio, industries you operate in, geographies you operate in.
Nitin, but that's an answer that you've given me. I'm now trying to ask you whether you believe companies are doing it. Okay, fine.
I haven't finished the answer, right?
Sorry.
So, very broadly speaking, I think there's a lot being done. I have a lot of respect for this industry because we've been written off at least a couple of times before, right? And I will go back to what I said earlier. I don't think you will be able to see every company come out of this on the right side. So there will be some that will probably not have done enough, and will probably see headwinds for a period of time. And we've seen many examples of that, even in the top 20, top 10, top 20 names in our industry. So it all again goes back to understanding what is needed to be done, evolving an evaluation process for saying, okay, these are the signs that I'm going to look for. Are you making enough investment in IP? Are you making enough investment in capability? Are you actually showing deal wins? Are those deal wins delivering the right outcomes for customers? And more importantly, if we play this right, 2 years out, we should have operating leverage that is better than what we have today. Because remember, today's model is very linear. To grow 10%, or rather yesterday's model was very linear. To grow 10%, you need to grow headcount by 8% or 11%, depending on where you add people. If you get that non-linearity going, we probably could be in a really sweet spot, and the multiples might even expand for companies that are able to show that kind of growth with that kind of operating leverage.